Welcome to Private Lending Insights. I'm your host, Rocky Butani. In this episode, I interviewed Wesley Carpenter, co-founder and partner at Stormfield Capital. They are a large debt fund out of Connecticut that lends mainly in the eastern states. They lend on residential properties primarily, but also do a lot of multifamily value add and a little bit of commercial real estate lending. I asked them to share some insights about some of the core markets that they lend in, mainly Connecticut, New York, and New Jersey. We touched a little on their company, their operation, their capital structure, and the funds that they manage. I hope you find this episode to be insightful. Here's my interview with Wesley Carpenter. Wes Carpenter, thank you very much for joining me for Private Lending Insights. How's everything at Stormfield Capital been this year?
It's great. Things are excellent, Rocky. Nice to see you, and thanks for having me. Really appreciate it.
Of course. So tell us a little bit about your business activity this year and anything new that's happening at Stormfield.
Yeah, 2025 is, it's been a year that hasn't been without its challenges. Anyone operating in real estate or capital markets, knows that. But I think that's one of those things, one of the things we love about being a bridge lender is that we're so often able to find opportunity in all market environments. And so I think that's kind of what we take as our task. Whether we're in a pro-cyclical or counter-cyclical environment, right? A bridge loan can be a productive solution, through all market cycles. And so I think, the onus is on us to make sure that we're out there in the market, telling our story and ensuring that, brokers and sponsors understand that we can be a solution for them, in these environments.
Okay. And tell us about any trends you've seen with at least the real estate investors that you do business with.
Yeah, I mean, I'd say, I think maybe just to kind of orient, to make this poignant for where we are, right? It's 2025, we're on the back of a, pretty aggressive rate rising cycle. We actually just got our, first 25 basis point rate cut here. So I think, probably to summarize, the sentiment we're seeing in real estate investors is I think there's renewed optimism for the future. I think broadly speaking, there's an optimism that, maybe we've quote unquote found the bottom of real estate prices, in certain assets. Obviously, I'm speaking very broadly, right? We at Stormfield, we lend against, a wide array of real estate assets, multifamily, single family, commercial. So all of these assets are obviously behaving differently, but I think in mass, right, markets have been frozen due to, the rapid rise of interest rates. And so I think we're starting to see investors' sentiment shift towards, positive momentum, believing that this first cut will be the first of three, and that transaction activity will largely pick up again.
Do you anticipate activity to increase for the remainder of this year? Or do you think it'll really kick in next year?
We've frankly already started to see, the increase in transaction activity. It's been a slow, kind of a slow acceleration throughout 2025. I think given where we are now, we're speaking in late September 2025. So there's always a lot of seasonality to this business. I think it's just human nature. People, deals that were procrastinated on. It's always kind of like late November. People realize if I want to get it done in 2025, I need to start working now. So at Stormfield, for the past decade, November and December have been our busiest months throughout the year. So, we're expecting that to happen again here. And so based on our, acceleration into the, late third and early fourth quarter, we're excited for 2025 to be a good production year, and then are optimistic that 2026 will follow.
And with people doing value add projects, do you think that they're anticipating that rates are going to come down over the next two Fed meetings? Do you think that they're going to try to increase their activity now, anticipating that when the third rate cut has been done next year, that it'll just be easier to sell a property or refinance if that's their exit strategy?
What's interesting about what I'm observing in the market now, I think this interest rate cycle has caused a lot of market participants, particularly, and that applies to value add multifamily investors, quite frankly, to be more cautious than they've been in the last, 6, 7, 8 years. Um, right, quite frankly, multifamily investors, value add, kind of through the spectrum, they've had a broad tailwind, for the past 8 years. And I think, quite frankly, a lot of the folks that are getting washed out right now are the folks who, they're younger, they've never been through a cycle, they didn't have the discipline. They thought that, they could always, refi at, 4%, and they thought cap rates would just keep falling. And so the investors that frankly have survived and that are investing into this market right now, um, frankly, look, they have some battle scars and they are being more cautious. So to answer your question, I think there is cautious optimism, that we're going to see, two rate cuts before the end of the year, but folks are being a little bit more conservative in their assumptions.
Are there any other challenges that you've heard of from your real estate investor clients besides the interest rate being high?
Uh, yeah, yeah. I mean, I think the one that kind of we all know about is is insurance. And I think people think of that as solely a coastal, like a true coastal issue. Um, but for those who aren't on the front lines like we are, which the definition of the coast is actually pretty broad. A lot of insurers, will view some sort of coastal risk as much as 120 miles inland. And so that challenge, right, largely kind of started with yeah, obviously hurricanes, multiple hurricanes in Florida, wildfires in California, which have obviously affected rates. um, that is affecting the industry and the country, pretty significantly. And it's not just, this isn't just homes that are literally on the coast. It's affecting a lot more of the market. And so that's where we lend. We have a lot of lending activities in, the Northeast, inclusive of New York, New Jersey, Massachusetts. And yeah, it's just a large swaths of those, borrowers are having trouble getting, sometimes getting insurance at all. And other times the premiums have just become prohibitive.
Interesting. It seems like everyone thinks about insurance issues with just Florida, and even though there's not a lot of storms that happen in the Northeast, that does make sense that insurance companies would still consider those as a risk because there could be a storm in the near future because they always happen. But that's interesting. I never thought of the Northeast as one of those markets that insurers are really hiking rates or just rejecting policies altogether. Let's talk about loan volume. As far as the number of loans that you funded and the total dollar amount, from the stats I've seen on forecasa.com, it looks like last year was quite a bit higher than your loan volume this year. It seems like from the data I see, you've crossed 200 million in loans, for this year to date. Is it mainly lower than last year because there aren't enough deals, or is it just that there's not as many real estate investors pursuing value add deals as much as they did last year?
We love Forecasa, and their market coverage is getting better every week, but it is not comprehensive yet, and we know they're working towards that. So what I would just say for the record is, our aggregate volume for 2025 year to date, um, is just over 400 million. And we're on track, with our pipeline and that kind of seasonality I discussed to potentially touch, it's like 575, 600 million will be our aggregate production for this year. Um, Likely a lot of that delta, relates to, true commercial loans, that we've made. But year over year, things will be flat to up 5 to 7%, really dependent on how that fourth quarter really plays out. But to answer your question, more broadly, I made the point about, you know, tr- trying to find opportunity in all markets. And I think that that is true, and that is a one of the beauties of this asset class. The simple fact of the matter is aggregate transaction volumes, in real estate, right, are still down. Right, I don't know the latest statistics, but I would assume 30, 40, 50% off their peaks. And so no matter how hard we work, right, you're still working into a smaller population of real estate activity.
Okay, interesting. Well, also the other thing I forgot to mention is for Casa's data. Sometimes it takes a while for it to, it takes a couple of months for them to get the data from closings, and there's a bit of a delay.
Some municipalities aren't so great with getting their security instruments recorded and published online.
Sure, definitely. But $400 million for year to date is quite remarkable. So that's great to hear. Have you seen a significant number of defaults with any of your loans this year?
Our default rate in the portfolio, is smack on our long-term historic average. We did see earlier this year, the kind of the 2021, 2022 vintage of loans did have a higher than average default rate. I think for kind of obvious reasons, right? Those deals were underwritten to, lower cap rates, interest rates shot up, borrowers' assumptions and pro formas no longer made sense. Fortunately, knock on wood, for us so far, our kind of conservative underwriting, has led to the, frankly, borrower's equity might not have been to underwriting, but our debt was still in the money. And so those loans have been resolving. And, the small handful that we still have on the books, I think, again, this interest rate cut that we saw has, given some renewed life to the opportunity of, these loans probably aren't refinances at this point, just given where our debt's accrued to. But I think with the sales market picking up a little bit, our sponsors should get out, preserving a few bucks of equity.
And let's talk about markets and states that you lend in. Which states and maybe metro areas do you prefer to lend in right now? As let's just say, over the last year or so, what are some of your favorites?
We're based in Connecticut. So, the majority of our book is in, Connecticut, Massachusetts, New York, and then the surrounding states. Now that represents about 65% of our total portfolio. Now we do have exposure down down the eastern seaboard. There are a handful of cities, along the eastern seaboard, and in the eastern seaboard states that we like, where the demographics are strong, and we ultimately think will persist through this little challenge that the Sun Belt is going through right now. But 90% of our portfolio is Eastern Seaboard, and then the balance is, suburbs of major cities, across the United States. But by and large, you can think of us as an East Coast, particularly Northeast lender. We've been, now why is that the case, right? A couple of things. One, we grew up on judicial foreclosure, right? So it's not something we didn't start in California, and then we look at foreclosing in New York and we say, oh my God, it can take you 3 or 4 years. That's kind of our base case, right? And that's kind of ingrained in our underwriting and our deal selection. So we kind of know that's an outcome. Ultimately, right, there is a premium you can earn by being willing to lend in those judicial foreclosure states. And so our investors enjoy that premium, right, when layering our asset selection on top of it. So that's one reason why we like to focus on the Northeast. The other is, right, real estate and lending against real estate, right? Real estate it's a local business, right? Blocks do matter, side of town, side of the train track, side of the river, right? Those nuances do matter in lending and in real estate. And so we just know the markets in the Northeast so well that we can be, much more tailored in our investment selection, decisions. Now, we have a little bit, fortuitous in that our existing portfolio is so heavily concentrated in the Northeast when you have, much of the value degradation that's going on in residential, particular real estate right now, happening in the Sun Belt. So our portfolio, has been largely, insulated from that. And look, while I'd like to say that it's mostly luck, like the simple fact of the matter is, there were many signs of what is going on in Florida. There were many signs for many months that this would happen, right? And just for to level set, for the viewers, because I don't know when they're going to be watching this or listening to this. As we sit here today, in many markets in Florida, single family home values are off their call it their 2021, 2022 highs by, 13 to 15%, right? Which I would characterize as a pretty material kind of market move. Now we saw signs of that. At one point our portfolio was, I think it was 22% in Florida, right? Obviously there was a big post-COVID, a lot of opportunity. Market was appreciating, greatly, great opportunities to support fix and flip investors down in that market. About 18 months ago, we started to see cracks, right? You started to see days on market increasing, et cetera. They're kind of the telltale signs that price declines would be coming. And so we've decreased our exposure to that market over the past 18 months from 22 to 12%, right? So these are things that you can do if you're looking for the signs and you take an active view on managing your portfolio.
And what are some states or markets that you'd like to do more business in?
Yeah, I mean, I think, for us right now, it's probably our core markets. So it's Connecticut with an emphasis on Fairfield County, New York, we love, all five boroughs. We love lending in Long Island, and then kind of your major cities, it could be, Albany, it could be Rochester, could be Albany, Rochester, Massachusetts, we love the Boston metro, and particularly the suburbs around Boston, is what we really like. The kind of the downtown Boston market does tend to be heavily, it seems to be very well served by a handful of local Boston lenders who tend to go very aggressive on their leverage, almost as if they, don't mind if loans go into default because they want to own the equity. So where we tend to have the most success is in those suburban markets around Boston, where we can make a good debt investment at the kind of the right basis and get an attractive return. But maybe thinking more just beyond our core footprint, right? Those markets, Boston and New York that we really love. We love the Raleigh-Durham area. There's a lot of kind of just long-term exciting things happening there. I think while there's a little short-term pressure on multifamily and single-family homes, I think the intermediate term demand drivers that have been built and are being built are going to be a tailwind to residential real estate over the next 3 to 5 years. So that's a market that we're we're focused on and investing in right now. And as much as there are challenges in markets like Florida, I think you can never you can't say, no, I'm not going to lend in a whole state. A whole state is tainted. There are some really interesting hyper local trends that are going on, within Florida. Right. And I think West Palm Beach is a particularly interesting kind of microcosm for that, just in that, West Palm Beach, for anyone who knows the market, has been there. There are so many submarkets, and now there are sections of West Palm Beach that we wouldn't consider investing in at all. But then there are sections of West Palm Beach, same city, where we are eager to deploy capital, right? And I think it's just a great example of within a state that is challenged overall, there are still pockets of opportunity within cities in a challenged state.
And how about getting away from the East Coast? Are there any states in the South, the Midwest, or the West that you like and are excited to do more business in?
I think a big thing for us is, while we have historically, not done a lot of business in California, we are actually in the process of getting our lender's license in the state of California. What we've ultimately found, and I think this is a testament to the processes that we've built and the reputation we've built, is we've started to see that both our borrowers and our brokers that we got to know, lending with and doing business with in the Northeast, for one reason or another, they might go and find an opportunity in California. And while they might be able to find a 1 or 2% cheaper solution, like say a fix and flip loan from a California-based lender, um, they're willing to pay a slightly higher rate to work with Stormfield just because they know about they know about our surety of execution, our draw administration process, et cetera. So we've seen enough of that. We've seen enough folks who want to do business with us in California to where we're making that investment and getting that licensure. The only other, I'd say, notable trend is, we have observed that there is a shortage of capital that's willing to invest, in earnest in states like, Wisconsin. And, I think it's easy for, as a, kind of coastal lenders, right? Your New York and your LA, your coastal lenders, right? We think that the coasts are the end all be all of the real estate markets here in the United States. We've gone on a couple due diligence trips to, some of the, the major cities in Wisconsin, for example. And, these are thriving cities with great universities. And quite frankly, investors who are, you know, eager to flip homes, just by way of example. And these investors, what we found, are largely served by, your old school kind of mom and pop, like true hard money type investors. And that's great, right? That's a great business. But, what we want to do is bring Stormfield's institutional execution to those markets and let those borrowers, benefit from that.
Nice. And does your desire to lend in a certain market or state depend on the property type? If, let's say, you got a commercial property loan, are you more excited about certain markets than others where you may be more focused on residential?
Yeah, it's great. I mean, it's a great question. The way I would characterize, commercial is, commercial is going to be so situation specific that it's right. It's an aggregation of what's the asset class, what's, state asset class, use case, demand drivers in that hyper local market, right? Does it kind of all make sense? Um, we look at, within commercial, logistics and warehouse is probably the asset class that we do the most in. And it's an asset class that's need obviously a big run up in values over the last 7 years, and is starting to show some softness. And it's a very right. It's a very nuanced asset class. It's, where are you relative to container ports? Where are you relative to northeast, north south, or east west interstates? Right? Where are you relative to, major logistics hubs? If you're not in one, are you in a secondary hub city or a tertiary hub city? And what products does your borrower's tenants, or your borrower, if it's owner occupied, right? Does their product fit, in that logistics, infrastructure? So it's much more, loan by loan, properties by property specific when you get into commercial.
One city that comes to mind, speaking of this, is Illinois, or Chicago, I should say, because there's a lot of lenders that are not willing to lend in Illinois due to their foreclosure process and just their laws over there. So is a market like Chicago one where you're more uh, you're more willing to do a commercial deal there versus a residential one?
Yeah, I think that's a great example and a great point. So I would say the short answer is yes. I think it's a little easier just because, right, you're making a very specific asset based and scenario based decision. It's not it's easier to look through like the broader portfolio level effects of Chicago's, right, the challenges that you've highlighted in Chicago. Now, I would say we do, we always try to be, at Stormfield, we're always trying to be a little bit differentiated than the market, right? And so, the market, right? So Stormfield originates for its own balance sheet, right? The market originates for securitization, I would say. And I'm talking about RTL specifically right now. And the market right now has characterized Chicago and Baltimore for similar reasons, in the same light, right? Some of it relates to some recent fraud activities. Some of it relates to the very pro tenant, pro borrower focus of the courts and judges in those markets, making it hard for lenders to foreclose. With that all said, and we've had bad things happen in most cities, right? Like we've had situations in Baltimore where we've gotten, run out by these types of judges, and we've had situations in Chicago where, what should have been a 1-year foreclosure turned into a 3-year foreclosure. To me, that's not enough to, that doesn't mean that we're not going to find good investments in those cities, even on the residential side. And so what I think it ultimately means, and the way that we mobilize, in that context, is it's about identifying the best deals, right? So, I'll be very specific, right? In Baltimore or Chicago, we don't want to do the $30,000 acquisition of a row house where you then invest $150,000 of CapEx, because you can find comps to say that you could sell it for 270 or 330. Right. We want to do, well, I'll leave it there. That's not the profile of deal that we want to do. If you do those deals in mass and you put 50 or 70 of them on balance sheet, they're probably going to default at a 10 to 15% rate. And then most of those are going to become REO. The sponsor is going to walk away because, with the markets underwriting today, the sponsor probably only has $10,000 or $15,000 in it. So it's effectively an option for the free option for the borrower. The originator doesn't care. It's ultimately going to be the bondholders in the equity that deal with it. So we try to find situations that are logical and that makes sense and that you and me would want to invest our money in, and those exist in Chicago. And so when we find those, we'll do them.
All right. Let's switch gears and talk about your loan program and just your lending criteria. Let's start with property types because you did touch on commercial, residential. You did mention with commercial, you focus mainly on your warehouse, light industrial. Are there any other commercial property types that you lend on?
Yeah, so we do selectively lend on retail, office, and then call it specialty use. Um, to give some context, our existing portfolio is just under 750 million. It is 90% single family, multifamily, and mixed use. It's about 5% logistics and industrial, and then 5%, all those other asset classes. So as much as we will make loans in those asset classes, we are predominantly a residential lender. Now those residential loans, right, we kind of break the world into two broad products. We have our RTL, our residential transition loans. That's a $200,000, our program up to $3.5 million program, 1 to 9 units and mixed use all go into that program. That program, I'd say that program constitutes probably 65% of our total business. And then our true commercial business is predominantly value add multifamily or special situation multifamily and or condo inventory, multifamily construction completion, and then the kind of that tail, well, then industrial, and then that tail of office and retail tend to be one-offs. So we'll probably do 5 of each of those loans a year. Triple net lease, RBs, where the developer developed the triple net lease building, put in the RBs. there was some 1031 money in there. He wants to kind of recap it before a sale, or very like not a ton of flow business, but when they come in, they're really attractive and we can execute quickly.
Makes sense. So commercial, very small part of the portfolio. Let's talk a little bit about multifamily. So we're talking about 9+ units for this program. What are the loan amount ranges when you get into more than 9 units?
Yeah, on the commercial side, which again we describe as greater than 9 units, because 9 and below would be an RTL. Loan sizes 3+ million to 25 million. And that's where we kind of look to stay. 25 million is right now the kind of largest that we feel comfortable putting on balance sheet, just given individual position size, effectively concentration limits. But I would say the average multifamily loan that we're doing is in the $7 to $10 million range.
Okay. And with the multifamily properties that you've funded in the past 12 months or so, are the majority of them value add projects? And if so, let's talk a little bit about the leverage that you offer for those.
Yeah, it's a good question. So the in the past 12 months, they've been fewer of them have been value add, I think, just given some of the challenges. But the majority of the loans, if you were to look over 36 months, would be value add multifamily, where we're typically providing 75 to 85% of the purchase. We're providing 100% of the CapEx program, up to usually a 60 to 65% loan to stabilized value. So structured, in many ways similar to a fix and flip loan. Obviously, it's a much more engaged, nuanced business plan when you're doing 75 units with common areas, signage packages, right, rebranding. Kind of a lot goes into those transactions. But there tends to be, right, relative to fix and flip, there are some very material differences which we see as nice benefits, right? So I guess the detriment to that, when you compare fix and flip to value add multifamily, fix and flip's great because the exit strategy is a sale, pay you right off. You have a little bit of capital markets, your refinance risk with the value add multifamily strategy, but you also have cash flow coming off these properties, right? One thing that we were never able to get comfortable with, and I think it's one of the reasons why our portfolio in the value add multifamily space has performed so well, is that we never got comfortable with the, buying a 150 unit or financing the acquisition of a 150 unit vacant multifamily in the suburbs of Atlanta, right? Because you have no cash flow coming from the property. And so the value add multifamily loans that we do, they'll tend to be, again, acquisition with anywhere between 75% and 95% occupancy, where the sponsor's going in and doing rolling renovations. And the point I'm making ultimately is that you have cash flow coming from this property throughout the life of the loan. And that's obviously a very valuable characteristic for any investment.
And you said lately in the past 12 months, you haven't done as many value add multifamily deals as you did in the past. So the multifamily loans that you've been doing lately, are those mostly bridge where it's just an acquisition, or are there refinances where they're just trying to buy some more time until they're able to qualify for the long-term permanent loan?
Yeah, most recently they've been so two scenarios. One is we actually done some construction completion. So situations where you think of these as like 30 to 120 units that are, got usually bank debt, get built to anywhere from 80 to 100% or 95%. And the bank, there's obviously been delays in construction. Bank wants their money back, and sponsor needs that last little bit of, capital to complete the project, get CO, and then, have, 9 months of leasing so they can get to occupancy. So construction completion on multifamily has been a interesting space over the past year. Tons of opportunity, enough to where we can find opportunity that we like. The other is um, recapitalizing value add deals that sponsor just needs more time, right? So they executed on their business plan. They, you know, leasing rates hit assumptions, but leasing velocity was a lot slower than they thought it would be. Thus, they didn't have enough term on top of the fact that, right, this past year hasn't been the greatest environment to exit into. And so I would say the super majority of multifamily bridge loan scenarios that you've seen over the past 8 months are, the sponsor looking to do a quote unquote cash neutral refi of their bridge debt. But cash neutral ultimately was looking for more money to cover closing costs than their existing bridge loan. It hasn't been a fact pattern that we can largely get behind, right? Because net, I mean, multifamily real estate values have come down. So the ones that we end up getting comfortable with and doing, quite frankly, are the ones where the sponsor, and there's multiple ways they can do this, shows renewed commitment to the project, right? And that could be an equity infusion at refi. It can be bringing in some cross collateral. Those are the types of loans that we're doing in this market.
Okay. Let's switch over to the residential space. So you said it's about 65% of your total loan volume right now,
Yep.
as with residential investment properties and like you said, smaller multifamily properties. Are the majority of those loans a rehab or a value add project?
Yeah, the majority certainly are, and it's probably around 70% have some amount of value add. Single family fix and flip, right? Value add multifamily just in a 2 to 9 unit footprint. Yeah, tend to be the majority. We like mixed use. I think that's just an asset class to point out. It's one that it's a little bit of an orphaned asset class, right? It doesn't fit into the 1 to 4 family bucket. Like, yeah, it's commercial, but it really tends to behave more like a small multifamily property. And so, when, we like the scenario where, urban location, single tenant retail on the bottom, right? A bodega, a small grocery store, something of that effect, something that is a staple for that neighborhood, right? A real resource for that neighborhood, 3 to 5 apartments above that. That's an asset we really love. And there's tons of those in Queens, Manhattan, Brooklyn, Boston. And so we're regular financing those assets as well.
And with the residential and small multifamily mixed use, tell us a little bit about the leverage. Is that any different than what you would do with a larger multifamily property?
It is. So, I think, we do go higher leverage on particularly 1 to 4s, but it does actually bleed into the 9 units as well. So, we do, like many folks, right, a risk-based pricing and sizing based on um, the obvious, right? So leverage points, guarantors, FICO scores, experience, we like kind experience. But we also look at um, collateral sellout values relative to median sellout values. And so if we deem a property to be more liquid for the market in which they're investing, we can actually increase leverage for that purpose or for that reason as well. So on like your straight down the middle single family fix and flip for a good credit, good experienced, sponsor, we can get as high as 90%, loan to purchase, 90% loan to purchase price, 100%, 90% of purchase, 100% of reno. Uh, we only go up to 70% LTARV. We are very much so that's what we do. I'll take a moment to observe that we are in a very the market is probably in its sixth or seventh inning now, I would say. Who knows? I try not to forecast, but um, leverages are going up, rates are going down, experience thresholds are going down. There is a very strong bid for fix and flip loans by securitizers and aggregators who securitize. And so, look, ultimately, I think the securitization market is serving the purpose that it ultimately and originally set out to achieve, which is making more capital available to more people. So I'd say that's a good thing, right? The securitization markets are doing what they're supposed to be doing. You know, one of the biggest lenders in the United States just made two changes to their program in the past week and a half, where they lowered their experience to get maximum leverage from 5 flips in 2 years to 3 flips in 2 years. And then right after that, they rolled out 100% loan to cost program for their highest quality borrowers. Now, their business is their business. But if you ask me as a debt investor, if lending 100% loan to cost is a good investment, I'd flatly say no, right? If I'm going to lend 100% of the capital for a project, I want the upside of equity, right? I should be getting a greater return if I'm going to be taking all the risk. And I think that's, that's just that's what happens when you have a lot of people chasing, right? Our industry has, really blossomed, right? And has very much institutionalized over the past 5 to 7 years. And there are, I think net for all market participants, it's a great thing. But as we saw, going into COVID, going into 2022, if just because the market structure will allow certain things to exist doesn't mean that they should exist. And, there were bankruptcies going into and coming out of COVID. There were bankruptcies going into and coming out of 2022. And there will be bankruptcies of originators and aggregators, coming out of the next market cycle whenever it is. And so I'm doing nothing more than observing history and projecting that history will repeat itself. And I only make these comments to ensure that everyone goes into whatever they're doing with their eyes wide open.
Definitely, it seems like this year, especially more than last year, there's just so much capital out there, and there's not as many deals. It's a very competitive landscape right now. So I too have seen some lenders that have increased their maximum leverage and reduced their experience requirements and have increased their maximum loan to after repair value up to 75%. And that's just the sign of the times right now, where there's just so much money out there, trying to chase these types of loans, and the securitization market obviously is driving that. So with that, how do you compete with some of those larger national lenders that securitize their loans? What are some of the reasons that real estate investors have decided to do business with you instead of any of those other competitors?
So it's, this isn't a new challenge. And it's, this challenge existed, back in, 2018, when we were only managing, 30 or $40 million. And it's starting to rear its head again, now. I think the way that we Stormfield compete is ultimately with, our capital structure. So we are effectively financed and structured the inverse of most lenders, right? Most lenders, and I'm going to oversimplify this, are $50 million of equity and, $300 million of debt, or, probably better said, $100 million of equity and $300 million of debt, right? We are, Stormfield is $750 million of equity and $100 million of debt. So what does that mean? What that means is, we are not the decisions that we make are not dictated by our warehouse provider. They're not dictated by our A note provider. If there are movements in interest rates, will they affect our portfolio? Potentially, but they're not gonna, week to week, month to month affect our cost of capital. And all of those things allow us to be more nimble, more dynamic, and that's more nimble and more dynamic to serve our investors, meaning the LPs that give us capital, meaning that we can respond favorably when there are interest rate cuts or rises, but really for our borrowers, um, you know while markets are firing right now and securitization is firing, right, it's great. um, but what's going to invariably happen is there's going to be another seizure, and when that seizure happens, Stormfield will keep lending, right? And that's when we tend to pick up a lot of our relationships. And as much as cost and your coupon, I don't want to overstate this. People want the lowest coupon. You know, price is probably pretty far up there, but service is up there as well. And when you've been able to, for a sponsor who you bailed out, like coming out of COVID, they had a property under contract, their lender disappeared because the securitization market failed. You were able to come in, save that deal, save their, $75,000, earnest money deposit. That goes a long way in building trust and reputation. And, those borrowers tend to be pretty sticky. And so, I think a lot of it just comes down to, again, our capital structure, serving our borrowers well through kind of all market cycles. And to make a point, when the market gets, so right now, let's just say there's a lender who's doing 100% loan to cost. There are lenders who are doing 75% LTARV. We're reducing our top tier from 5 flips in the past 2 years to 3 flips in the past 2 years. We're expecting interest rate cuts in the next, right before the end of this year. Everything points to this market getting more competitive before, not. And at some point we at Stormfield will say, we're not going to chase, right? So we will go to 70%. Historically, right, when you're in the Northeast, historically, 65% LTV. That's it. That's gospel. You talk to the old school hard money guys who were lending in the 80s, 65% LTV. That's what keeps you safe, through all market cycles. We have found a way to get comfortable to our best borrowers to lend 75% LTARV. The market's already at 70%. The market's already at 75. I don't doubt that we will see 80 or 85% LTARV, 100% LTC before the end of the first quarter of 2026. I would bet a few dollars on that. We're just not going to play that game, right? We will serve our borrowers at a level that we're comfortable at. Ultimately, right, we're investing on behalf of our limited partners. And at some point, if the RTL market gets too frothy, we'll step back and say no. And that's where we have the benefit of being able to transition our focus to value add multifamily, construction completion, condo inventory lending, right? We'll just redeploy our efforts elsewhere.
The last 2 or 3 years, so 2022 was a tough time when interest rates started going up. 2023 seemed like it was a bit of a transition year, but the last 2 years or so, or 18 months, it seems like the securitization market's been pretty stable, and there's a lot of new lenders that have popped up, lenders that have grown immensely. But how have you been able to acquire new clients in the past 18 months or so? Are you getting most of your deals from other originators or brokers? Because from what I've seen, you guys don't do a ton of marketing out there. But what's been driving business to you, and at least in the past 18 months?
We don't do a lot of trade shows, and that's kind of not our thing. We do a lot of direct to borrower digital marketing and advertising. And so really, what we view, we don't, and when I think about what we're trying to achieve with our marketing, it's not necessarily, steal a borrower from Kiavi or, Lima One or, one of those players. It's steal a borrower from, the mom and pop lender, right? The wealthy entrepreneur who has $10 million out on the street in Yonkers, who's been servicing, a real estate investor for the past 3 or 4 years. But he's charging him, 13% and 3 points. He has no back office. The borrower can never get account statements. And, the investor can only give him a maximum of a, $1.2 million loan. So that's where we're looking to pull, effectively earn market share from. And it's one of the beauties of this business, right? As much as our business has institutionalized and it's consolidated, quite frankly, there are still thousands and thousands of those, mom and pop, 10 to $15 million on the street, type of lenders, where if we can, articulate our value proposition effectively and directly to them, we can bring them into the Stormfield ecosystem, serve them for the first time, give them best-in-class execution and post-closing servicing, and then keep them in the ecosystem, but by cultivating that relationship.
Love it. And let's finish up talking about your lending guidelines. It tells a little bit about the pricing and the fees that you typically charge on most deals at this time.
So right now, and I'll talk RTL because it's a little bit more programmatic. Right now, our RTL pricing starts at 8.99% and 1 point. So for highly experienced, high credit borrowers who are doing business in markets that we like and exiting at price points that we think are appropriate for the market, 8.99% and 1 is achievable. Now that doesn't get them maximum leverage. That will get them to a 60 LTARV, and effectively they can buy the leverage up from there. I would say to give an accurate representation of where the majority of our money is being deployed right now, it's at about 10.5%. That's IO on a 12-month bridge loan with about 1.5 points. And typically what we'll do is 75 basis points in and 75 basis points as an exit fee. That's another unique, right? It's a somewhat unique characteristic of Stormfield doing an exit fee. And sometimes it has borrowers will have a knee-jerk reaction to it, but really it's a tool that we can actually use, right? Because we're originating the loan, we're holding it on balance sheet, we're gonna hold it when we exit. People, no one outside Stormfield needs to get paid with the fees, right? That those fees ultimately just go to our investor. It's a way of frankly just increasing, day one leverage for the borrower, right? Instead of them paying 1.5 or 2 points up front, we take half in the front, we take half in the back.
Nice. I like it. And how about credit requirements or liquidity requirements? You mentioned experience a little bit, but just in general, what are the borrower requirements?
So another, I'll say unique. So credit will dictate leverage and pricing. So we do have, so again, unique to Stormfield, we're not, so because we're not securitized and because we're not leveraging, no one can tell us that, a certain FICO score means no go. And so we don't do it all the time, but there are cases where, right, you can find, particularly on these are usually cash out scenarios, right? So it's sponsor owns a property free and clear or nearly free and clear. Unfortunately, he or she's had some credit troubles. They have a 550 FICO, but they own a 4-unit in Dorchester that's worth $800,000, and they just want to borrow $300,000 to maybe make some small repairs or something of that nature, right? So no-brainer investment from a security standpoint, an asset coverage standpoint. FICO score would kick them out of most RTL securitization lending guidelines, but on a case-by-case basis, we can make those loans.
Nice, like it. And with rehab projects, RTL loans, do you have certain liquidity requirements? Like, is there a stringent, hey, you have to have X amount of liquidity uh, in addition to you making your down payment on the acquisition?
So we do have liquidity requirements. I would say we try to the way that, right, 'cause I think it's prudent to have liquidity requirements. I think the way that we show flexibility is, the way that we qualify funds, for liquidity requirements. So if the most extreme cases, I want to see all cash or all, readily marketed securities, towards liquidity requirements. Then you'll see some people giving certain percentages for, 401ks or IRAs, that sort of thing. Um, we do all those, we do those things, but we also, look at our borrowers' global, real estate schedule. And if they have equity in other investment properties, we will give them some credit for that equity they have in other investment properties, which is, a pragmatic way that we can be flexible in helping borrowers qualify for our liquidity requirements.
Okay, nice. And as far as exit strategies go, with residential rehab or small multifamily rehab, are most of your borrowers selling their properties, or are you fine with a buy and hold strategy?
I think we're fine with the buy and hold strategy. We just like to ask that our borrowers tell us what they really want to do. I think a lot of times borrowers will, to make it fit, like the fix and flip program, they'll tell you they want to sell it. And, for us, we just want the truth. And if your goal is to buy it, fix it, and then refi it, that's fine with us. Just tell us that so we can underwrite the exit, right? And so I think that's one thing that we've invested a lot of time on because of our multifamily value add multifamily line of business. In that business, right? Pro forma underwriting the takeout loan is of critical importance when you're underwriting the bridge loan. And so we kind of brought that mindset into the kind of small balance, multifamily space, the RTL space, when people are doing twos to nines, even ones to nines, quite frankly. Um, if you want to buy it and hold it, that's fine. We just want to be able to do a pro forma underwrite to say, like, you know, this borrower is, qualifies for all takeout types, bank, DSCR, et cetera, et cetera. Or, we want to know this guy's not going to qualify for bank. He's got to go DSCR, because then what we do is we have in our models, right, where the DSCR market is, and we can do a pro forma qualification of that sponsor and say, yeah, look, he's got the FICOs there, the cash flow, the pro forma rents will qualify him, and the DSCR loan will be sufficient to pay off our bridge loan.
Nice. And with some of your larger deals, uh, uh, how do you handle appraisal and valuation? Are you, in addition to having the valuation, are you typically doing site visits to go see the property and meet the borrower?
Yeah, we see, we have a number of internal guidelines that we adhere to, which are, if a loan is over $2.5 million, a member from the Stormfield team will physically see that property. That's regardless of where it is in the country. If a property is within 75 miles of our office, we will see that property. And what that ultimately, what those two rules get to is that a member of the Stormfield team will see 85% of our dollar volume of loans. Um, Now we do, on the commercial side, we're doing your full suite of third parties, right? Appraisal, property condition report, zoning report, environmental. On RTLs, um, we use a process that appropriately assigns the valuation type based on the size and the complexity of the transaction, which is a long-winded way of saying we don't always use appraisals. We use reports from firms like Richer Values, from Clear Capital, and then some other kind of, more automated reports when we can supplement that with a site visit to get to value, right? And again, it's a risk based kind of assignment of valuation methodology, right? It's not because no one's telling us what we need to do. We're just trying to make the product as user friendly and cost efficient for our borrowers as we can, while simultaneously ensuring that we have the right controls and procedures in place to protect our investors.
Great. Is there anything else about your lending guidelines or lending criteria that you wanted to add? Anything I might have missed that may be important?
No, I mean, probably just, if it's probably obvious with some of my comments, but speed to closing. I feel like it's one of those, right? This asset class, right? Asset-based lending, at its core, it's always been a, quick to close, right? Time is of the essence type lending product. And I think we've lost a little bit of that with securitization. And so, when I'm speaking to, brokers and borrowers out in the market, the number one thing I remind them of is it's one of the biggest benefits of our platform, and the fact that we hold everything on balance sheet, is that if you have a transaction that needs to close quickly, and you're willing to, put the work in on your side, we can close quickly, right? This isn't the norm, right? The norm is 7 to 9 business days. That's how quickly Stormfield closes on average. But we have closed, a dozen plus loans this year in 2 to 4 business days, right? And anyone who's in the business knows it's really hard to do that. And there need to be a lot of pieces that are already maybe even pre-aligned before you can do that. Title, right? Valuation, any kind of third parties. But I think it's a testament to our balance sheet and our ability to execute that we can actually close in, 2 to 4 business days when necessary.
Excellent. And with that, why don't we take a quick break and we'll be right back. Support for the show comes from Ross Diversified Insurance Services. All real estate investors and all private mortgage lenders need insurance. More specifically, they need the right insurance partner. For over 35 years, Ross Diversified has been the trusted partner for over 3,000 property investors and 500 lenders throughout the United States. If you're a real estate investor, Ross Diversified can help you whether you're managing a single rental property or a large portfolio of rentals. And if you're a lender, Ross Diversified can protect you with force-place insurance for when a borrower's policy lapses, or with REO insurance in the case of a foreclosure. They offer competitive rates and hassle-free claims assistance. Licensed in all 50 states, Ross Diversified understands the unique challenges of real estate investing and provides customized solutions to safeguard your assets. Visit their website, rossdiv.com, to learn more and request a quote. That's ROSSDIV.com. Please mention that you heard about them from LenderLink and the Private Lending Insights podcast. All right, and we're back with Wes Carpenter, Stormfield Capital. So Wes, let's talk a little bit about some of the core markets that you lend in. Let's start with Connecticut, which is your home state. Tell us a little bit about the lending activity you've done there recently, and share any insights you can about why you like that market.
Yeah, I mean, besides being a born and raised, Connecticut native, now living in the state. Look, Connecticut benefits from, in a lot of ways. It's proximity to New York City. Southern coastal Connecticut, is beautiful and, kind of very affluent. And then you have, kind of diverse counties and cities up north. And so, to characterize our lending activities in Connecticut, we do a lot of, higher value single family homes along the quote unquote Gold Coast in, Fairfield County, Connecticut. So these are towns like, Greenwich, Darien, New Canaan, Fairfield, Westport, Southport, where median home values are, upwards of, median home values are, $1.5 million. So, and then we'll go into other markets, like Hamden, Connecticut, Trumbull, Connecticut, New Haven County, where, your average home value is about $500,000. So kind of comfortable lending across the spectrum.
Nice. And if you could maybe give us an example of a deal that you've funded in Connecticut recently.
Yeah, so we just financed this is a fix and flip acquisition of a gated but large single family home in New Canaan, Connecticut, where the purchase price was $1.6 million. Borrower had a $400,000 renovation budget. And so maybe just for context, think of this as a, late 1990s type finishes. So floors needed to be refinished, kitchen cabinets needed to be replaced, tile in the bathrooms needed to be replaced, but the bones of the house were really good. It was just really the cosmetics. And ultimately, so we closed that loan a few weeks ago, underwrote it to a 65% LTARV. And again, in a town like New Canaan, Connecticut, that's a very comfortable sellout value.
Nice. And let's switch over to New York. From the data I have on Forcasa, it looks like the majority of the loans you funded since inception or since the data has been available, the majority of your loans have been in New York State. Tell us about, your lending activity in New York as of the last 12 months or just this year, and what do you like about the market? And maybe give us an example of a deal you funded there.
Yeah. So what I love about New York, I think, right, New York City is, I think, one of the greatest cities in the world. It's a perpetual demand driver. And then you have submarkets around Manhattan proper that are as large as some of the biggest cities across the United States, right? So you take Brooklyn. Brooklyn, it's kind of a city among a city. And there are so many unique submarkets within Brooklyn that are constantly changing. And so I think at any point in time, you're able to kind of find, interesting pockets of risk, depending on where you are in a market cycle. And so sometimes you want to be, really focused on, going in and investing only in kind of prime markets, right? So Williamsburg, Dumbo, etc. But then as you're kind of in a kind of a pro-cyclical market environment, right? You might start to see kind of gentrification pushing into, outer parts of Clinton Hill and Fort Greene, etc. So it's a really fun place to invest in because each of these, right? Brooklyn is a submarket of Manhattan, I would say. And then within Brooklyn, you have like kind of your own little mini cities and microcosms. So it's a really fun place to invest. Um, for example, we just did essentially a condo conversion deal where a 6-unit multifamily was built with the infrastructure to convert it to condos, but there was some work that needed to be done. So the mechanicals, when it was built 18 years ago, were built for future condo conversion. But this particular deal was being bought as multifamily with the plan of condo conversion. So we provided acquisition financing, and then we provided the CapEx financing, not necessarily for the mechanicals because those were already in place for individual condos, but just for a cosmetic renovation of the units. So the sponsor, just like a fix and flip, would renovate the individual units, and then ultimately file, a condo book and then sell them out as individual units.
And beyond New York City, because you said you do lend in all five boroughs, what other parts of New York State do you lend in?
We love Long Island, right? Like Long Island is a massive residential market. Much of it is proximate to New York City, so we do a ton across Long Island. And then I would say we put on some risk in Albany, and then some risk in Rochester. Those are probably the biggest markets that we lend in.
And how about Westchester County? Is that a desirable market for you?
It is, yeah, yeah. Southern Westchester County. We very much like, right, we kind of want to be, you kind of want to be 30-45 miles kind of from Manhattan. Generally want to be within, you know, people have differing opinions. I think if you can be within a 1 hour train ride or a 1 hour 15-minute car ride with traffic from New York City, it's truly commutable. And so if you're anywhere, in Westchester County in that range, it's something that, a market that we really love. You start getting up to, upper Westchester County, um, it's different. It's not to say we can't lend there, but it's not a commuter location. You're not going to get people who are, earning those New York City salaries.
Sure, makes sense. And let's shift over to New Jersey, just across the river. It seems like northern New Jersey is pretty much just, the same as New York City. It's just an extension of New York City. But is there anything that's unique about that part of New Jersey?
No, I mean, not other than, right. I think you get the benefit of being proximate to New York City. If it's, the same story where you need to kind of understand your very specific, hyper local markets and, what's social trends in those markets, right? Like, where can it, where is a $2.5 million house appropriate and where is it not appropriate, right? Where's the median home value more like 1 million? And if you try to sell a 2.5, you're going to lose your shirt, right? So obviously just kind of understanding, those dynamics and really understanding why. That's the key, right? Everyone can observe the data, but it's understanding why why the data exists in the way it does and why the human behavior exists. Um, yeah, and then, but that's not to say, we do lend in kind of mid and southern New Jersey. But I'd say it's certainly not as dense as northern New Jersey, right? Just because of proximity to Manhattan.
Any recent deals in New Jersey that come to mind?
We recently did it was an acquisition of a mixed use property. So, sponsor was the longtime operator of the bodega, the grocery store. Um, and he'd been paying rent to his landlord for many years, 20 plus years, and the landlord ended up putting the property for sale. And so the sponsor wanted to, acquire the property. And so this was a 4/1, mixed use property in Jersey City. So what we liked about the deal, obviously, it's an asset class we like. It's an area that we like. Again, Jersey City is very much commutable to Manhattan. And the biggest challenge with mixed use is, are you going to be able to rent the retail, right? The resi will always rent. It's can you rent the retail? And in this case, the sponsor had a very successful, long time thriving business in the space. So we thought that was an exciting scenario that we can get behind.
Nice. All right, let's shift over to talking a little bit about your company. You mentioned that you have $750 million of assets under management. And so obviously Stormfield is more of a debt fund structure. Tell us a little bit about your operation before we get into the capital.
We're an SEC registered investment advisor, manage $750 million. Our investors are university endowments, charitable foundations, family offices, and wealth management firms. We're in a team of 23 employees, offices in Southport, Connecticut. Functional roles at the firm, we have investment origination, we have loan servicing, accounting, special servicing, and then investor relations are kind of the functional roles that folks fall within. Um, and I just kind of underscore and highlight the fact that, we service our entire portfolio in-house, so we don't use a third-party servicer. And that's just another piece of our value add, both to our borrowers and to our limited partners and our funds.
And when did you start Stormfield Capital?
I'm co-founder, Tim Jackson. We founded Stormfield in 2015 and launched our first fund, the Stormfield Real Estate Income Fund, in October of 2016.
As far as the fund goes right now, do you have multiple funds that you operate?
So right now we're investing out of, our flagship fund is a domestic limited partnership, the Stormfield Real Estate Income Fund. It's a Delaware domiciled limited partnership with a REIT subsidiary. The majority of our assets are in that fund. We in 2022 we launched a parallel offshore fund. So it shares the same exact investment strategy, but it's just set up for overseas investors who are looking to invest in, real estate, U.S. real estate secured debt. And then we're currently also investing out of two funds of one. And so those are funds that were set up for one investor. In one case, it's a university endowment. In the other case, it's a charitable foundation. And they, same exact investment strategy. It's just that given the size of the checks that they were writing, they didn't want to be lumped in with other investors. They wanted their own vehicle. So we were able to structure that for them, and we invest on their behalf.
And do you have, like in your main fund, do you take on high net worth investors, or do you mainly do business with institutional type investors?
We do, we do a ton of business with high net worth. The majority of that high net worth, though, will come in through wealth managers. So, wealth managers really in earnest, back in 2017, 18, right, when interest rates were zero and had been zero for a little bit, right? They went on this search for yield. And in the search for yield, a lot of these entrepreneurial wealth managers found real estate bridge lending as an asset class. And so that trend has frankly only continued as they've learned about the really attractive risk adjusted returns that we can generate in this strategy. And so, in the end, our end clients are almost, not almost exclusively, but they're probably 80% high net worth individuals. It's just that the channel will come in through is a boutique wealth manager, usually managing between $1 and $5 billion, who will put us into their model portfolio for their clients to generate, a fixed, a high yielding fixed income alternative.
And within this world of investing in private mortgage funds, the term private credit is commonly used. Is private credit just a term that's mainly used by institutional type investors and wealth managers, or do they commonly refer to it as private mortgage funds?
It's a great question, and an interesting one. Um, right. The asset classes that are private credit have existed for 20, 30, 40 years. It's just that we now have this new moniker of private credit. I think when most people when institutional asset allocators refer to private credit, they're most commonly referring to direct lending, right? And that's right, lending to companies, usually private equity backed companies. So as banks consolidated, they pulled back from, leveraged lending into LBOs, right? The private markets came and filled that void, direct lending. So I think that's what most people are talking about when they say private credit. But another sleeve within private credit would be, effectively like specialty finance. And oftentimes real estate secured bridge lending will be one of the, multiple stool legs of specialty finance, right? So it could be like RTL lending, and then it could be like litigation finance, and other types of like esoteric specialty credit products.
So do you think bridge lending is more of a common term that people would use to refer to our industry, or do you think RTL is a bit more popular?
Yeah, it's a great question. We refer to it as real estate secured bridge lending, right? Because I think it most concisely articulates what we do without using too much, industry jargon. We feel like with most of the institutional asset allocators we speak to, um, they may have heard RTL, but they don't really understand that it's a synonym for fix and flip, right? And then open question, is it a synonym for fix and flip, right? Because the definition has changed and morphed. I think it originally was, but it's not anymore. So we just use real estate secured bridge lending as a asset class within private credit, and we think that's the best, most accurate descriptor.
And then last thing I wanted to ask you about is when we first connected back in early 2020, uh, we got you listed on our platform, and then at the time it was kind of tumultuous because, this is when the COVID shutdown started happening, lenders started pausing. You were at the time buying loans from other lenders. And I remember you had a separate fund set up for that at the time. Is that still something that you do? Is that still part of your investment strategy?
It's not right now. Just the market, the market, all other things being equal, we'd rather originate a loan. But, when there are opportunities, to buy, very attractive opportunities, we will. So, right now I'd say there's a lot of money out there. There was a lot of just distressed debt raised post COVID that people had trouble deploying. And there's, those fund managers are still trying to get that capital invested during their investment periods. So, the returns you can earn on non-performing loans just aren't as attractive, or aren't attractive relative to what we can earn on originating performing loans. But we will again, right? So when the market turns again and, loans need to be sold out of the securitization market structure because, the bid goes away for the A tranche for any reason or not, we'll be ready to jump on that opportunity again.
Excellent. Well, that's all the questions I had on my list for you today. Was there anything else I missed? Anything else you wanted to add?
No, other than just, thanking you for, the very thoughtful, questions. I've done a fair number of podcasts, but I could say, you were one of the, you're in the top decile of knowing this business and knowing the right questions to ask. So it's really nice, obviously, to have a conversation with someone who's so knowledgeable about our space, but it makes my life easier just talking about, the right, the obviously right things for our industry.
Sure. Really appreciate that. Well, Wes, thanks so much for your time today, and look forward to seeing you at a conference soon. And, thanks for all your insights.
My pleasure. Thank you, Rocky.
And that's a wrap for this episode of Private Lending Insights. Stormfield Capital has been listed on privatelenderlink.com since 2020. I put a link to their profile in the description. Check out the profile to learn more about them and their lending guidelines. You can call them directly, send them an email, or submit a loan request form to them. When you reach out, please mention that you heard about them from LenderLink and the Private Lending Insights podcast. This weekend, I'm heading to Scottsdale to attend the National Private Lenders Association conference. I'm going to be talking to a lot of lenders, brokers, capital providers, and service providers. I'm going to get a good update on what's happening in the industry, and I'll be sure to share some insights with you of what I learned in the next episode. Thanks for tuning in and listening all the way to the end.